Imagine you're ready to buy your first home. You've saved every penny, watched interest rates like a hawk, and finally, you're filling out your mortgage application. But there's one problem. You own a sizable amount of cryptocurrency, yet your mortgage lender doesn't count it as part of your assets. Frustrating, right? Now imagine a world where your Bitcoin, Ethereum, or even lesser-known tokens could actually help you qualify for a home loan. Sounds futuristic? Well, it's not as far off as you might think. The Trump administration, through the Federal Housing Finance Agency, has signaled a major shift. They want to allow homebuyers to back mortgages with crypto. But why now? And what does this mean for millions of Americans who've invested in digital assets? To understand this, we need to unpack the directive issued in June, which instructed mortgage giants Fannie Mae and Freddie Mac to explore using cryptocurrency as part of their risk assessment for single-family homes. This isn't just a minor tweak to mortgage policy. It could fundamentally change the way Americans buy homes. Here's the problem today. Roughly 15% of Americans hold some form of crypto. That's millions of potential homebuyers whose wealth is invisible in the traditional mortgage world. Banks and lenders typically look at cash in the bank, retirement accounts, or other liquid assets. Your crypto? It's seen as too volatile, too unpredictable, too risky. And that's why, until now, it hasn't counted. But the financial landscape is evolving. Crypto has matured. Major exchanges now report millions of dollars in stablecoins and liquid assets that can, in theory, be converted quickly into cash. So the question becomes, should crypto be treated like cash, a volatile stock, or something entirely new? The FHFA seems to be betting on the latter. There's another angle here: political and economic strategy. The Trump administration's push reflects a broader goal: embracing innovation while stimulating the housing market. Allowing crypto as a mortgage asset could unlock a pool of buyers who were previously sidelined. Think of it like opening the floodgates to a new wave of demand in a market that's been struggling with affordability issues. And here's where it gets really interesting. By counting crypto as part of a borrower's portfolio, lenders may need to rethink how they measure risk. Historically, mortgages are based on steady income and low-risk assets. Crypto is anything but steady. Its value can swing 10%, 20%, even 50% in a matter of weeks. So how can lenders reconcile this volatility with the need to avoid defaults? This is the puzzle Fannie Mae and Freddie Mac have been tasked with solving. Some critics worry that incorporating crypto into mortgages could be a disaster waiting to happen. Imagine a borrower whose crypto portfolio crashes right after closing on a home. Suddenly, their financial cushion evaporates. On the other hand, proponents argue that ignoring crypto is like ignoring a whole segment of wealth that could help more people achieve homeownership. This isn't just theory. Real-world examples illustrate the stakes. Take the crypto boom of 2021. Millions of Americans saw their digital holdings double, triple, or even quadruple in value. Many of them could have qualified for mortgages if crypto were counted as an asset. That's a lot of untapped home buying power. But there's a balancing act. Regulators have to weigh innovation against risk. They must ask, can we protect the financial system while giving homebuyers more options? Can crypto's volatility be managed in a way that's fair to both borrowers and lenders? And the clock is ticking. The housing market is at a tipping point. Prices have surged, affordability is declining, and buyers are searching for any advantage. In this environment, allowing crypto as a mortgage asset could be the catalyst for a new wave of homeownership, but only if it's done correctly. Further, we'll dive into how this directive might actually work in practice, the mechanisms lenders could use to include crypto in mortgage applications, and the potential consequences, both positive and negative, for the housing market, crypto investors, and everyday Americans. So, how could this actually work? How can a lender take something as volatile as Bitcoin and treat it like a stable asset for a mortgage? The key lies in valuation, liquidity, and risk assessment. First, let's talk valuation. Crypto prices fluctuate constantly. One day your Bitcoin is worth $30,000. The next it drops to $25,000. Lenders would need to find a way to lock in the value of crypto at a specific moment. This might involve using an average value over a period of time, or focusing on assets held in stablecoins, which are designed to maintain a steady value. Next, liquidity. A mortgage lender isn't interested in assets that can't be easily converted to cash. That means borrowers would likely need to prove that their crypto can be quickly liquidated if needed, through verified exchange accounts, proof of ownership, and a track record of transactions. It's similar to how banks verify stocks or retirement accounts today. The difference? Crypto moves faster, crosses borders instantly, and operates 24/7. A new reality for mortgage underwriting. Then comes risk assessment. Traditionally, lenders look at your income, credit score, and existing debts. Crypto introduces a new variable, volatility risk. To manage this, Fannie Mae and Freddie Mac might implement haircuts, reducing the assessed value of crypto to account for potential price swings. For example, if you hold $100,000 in Bitcoin, the lender might only count $70,000 toward your mortgage. It's a conservative approach designed to protect both the borrower and the lender from sudden market shocks. But the implications go beyond individual mortgages. If crypto becomes a recognized asset class for home loans, we could see significant changes in the housing market. More buyers could qualify for loans, increasing demand for homes. That might push prices higher in already hot markets, or provide a boost in areas that have been stagnant. Essentially, we could be looking at a crypto-fueled housing boom. There are also economic ripple effects. Allowing crypto-backed mortgages could encourage more people to invest in digital assets, knowing that they can use them as real-world financial leverage. It could also prompt other countries to explore similar policies, creating a new global dynamic in both housing and digital finance. Of course, not everyone is convinced. Critics warn about systemic risk. If the market crashes, lenders could be left holding the bag. Remember the 2008 housing crisis? That disaster started with high-risk mortgage-backed assets. While crypto isn't identical, the fear is similar. Volatility could create unexpected defaults, especially if homeowners over-leverage based on inflated crypto values. Then there's the regulatory challenge. The U.S. government would need to establish clear rules for how crypto is treated in mortgage underwriting. Questions arise: which coins qualify? How often is valuation checked? What happens if the borrower loses access to their digital wallet? These are all unanswered questions that Fannie Mae and Freddie Mac have to address before any policy rollout. Yet there's a compelling argument in favor of the change. Millions of Americans are sitting on digital wealth that could be mobilized for homeownership. For some, this could mean finally affording their dream home. For others, it could be a chance to refinance and take advantage of favorable rates. Essentially, it democratizes access to mortgages in a way that traditional banking has never done. Consider the average millennial homeowner. Many of them are digital natives, comfortable managing crypto portfolios, but struggling with rising home prices and student debt. Including crypto as an asset could give them a leg up, bridging the gap between digital wealth and tangible property ownership. And let's not forget innovation. The financial system has always evolved. From the introduction of credit cards to online banking, each innovation faced skepticism. Crypto-backed mortgages could be the next step. Controversial? Yes, but potentially transformative. In the next part, we'll explore the broader consequences, potential pitfalls, and what this could mean for the future of both crypto and the housing market. We'll also discuss what it means for you, the everyday homebuyer, and whether this policy could reshape the American dream. So, what does this all mean for the average homebuyer and for the economy as a whole? The potential impact is huge, but it comes with caveats. If the Trump administration's directive becomes reality, millions of crypto holders could suddenly qualify for mortgages they previously couldn't access. Imagine someone who bought Bitcoin 5 years ago, watched it grow, and now can leverage that digital wealth to buy a home. That's a dramatic shift in purchasing power. And it's not just theoretical. This could accelerate homeownership for a generation that's been priced out for years. But there's a flip side. Crypto is inherently volatile. Prices swing wildly. If the market drops sharply, some homeowners could find themselves underwater on their mortgage, even if they qualified based on their crypto holdings. Lenders will have to be cautious, using conservative valuation methods and risk-adjusted calculations. Otherwise, we could see a new kind of financial stress, one that blends the unpredictability of crypto with the stability of real estate. There's also a philosophical shift at play. Traditionally, banks have measured wealth in cash, stocks, and bonds, assets you can easily value and predict. Crypto challenges that model. It's decentralized, digital, and global. By allowing it to back mortgages, the U.S. could be acknowledging that the future of finance is not just dollars and cents, but digital assets too. We're entering uncharted territory, but it's worth noting that regulation and innovation often evolve together. Think of the early days of the internet. Many were skeptical, yet we adapted, and it became part of everyday life. Crypto-backed mortgages could follow a similar trajectory. With careful implementation, risk controls, and clear guidelines, this could become a standard part of the financial ecosystem rather than a fringe experiment. For crypto investors, this is a reminder. Your digital assets might have more real-world power than you realized. For policymakers, it's a balancing act between unlocking opportunity and managing risk. And for everyday Americans, it could represent a new pathway to achieving the dream of homeownership, one that blends traditional finance with the digital economy. So, what should you take away from all this? First, change is coming. The financial system is slowly adapting to digital assets, and housing policy is no exception. Second, volatility doesn't have to be a barrier. With smart policies, it can be managed. And finally, opportunity often comes when others see risk. For those willing to understand and navigate the new rules, the door to homeownership may be wider than ever before. In the end, allowing crypto to back mortgages isn't just about homes or digital coins. It's about the evolution of finance itself, a step toward a future where wealth is measured not just by dollars in a bank account, but by the assets you hold in the digital world. If this policy is enacted successfully, it could be a game changer, reshaping the housing market, boosting demand, and giving crypto holders newfound financial leverage. But it will require caution, innovation, and vigilance, because the stakes are high and the lessons of past financial crises are never far away. Thanks for watching. If you found this video insightful, don't forget to hit the like button, leave a comment with your thoughts, and subscribe for more deep dives into the world of finance, economics, and investing. And be sure to check out our other videos to understand the trends shaping money, markets, and the economy today.